Okay, folks, it is 2:05. Tim Goff here, the founder and CEO of My Ground Force, host of your webinar, the webinar series, How to Increase the ROI in Your Business, talking about profit, increase in profit in TSP businesses. Today, we're going to talk with Kevin Brunner, former combat Marine, expert on a number of tax planning strategies, including how to exit any business. And today we're going to talk about your FedEx TSP business, how to maximize the money that you keep. What's the right exit strategy? So I've known Kevin for a couple of years. Again, we share an aviation background. He as a Marine, me as a Navy guy. And he is as honest as a day is long. And you're going to see as we go through here, Norb Kohler also works with Kevin on occasion. And, you heard from him last week. He did an outstanding job talking about how to get into business, how to value businesses, how to acquire a business, etc. So we're going to follow the same format we always follow. I'm going to be quiet. I'll insert on occasion. We'll send some poll questions out along the way. But primarily, we're going to turn it over to Kevin. If you've got questions, you know how to post them. Just shoot them in the Q&A, and we'll get them handled for you. Again, we're excited today to talk with Kevin Brunner. Kevin, welcome to the My Ground Force webinar series.
Thank you, Tim. Glad to be here. I introduce myself, kind of why I have some credibility in the things I'm talking about. Even as a child, I started a business mowing lawns, hired other kids to mow lawns. Sold it my senior year in high school for $117,000 before I left for the Marine Corps, called Sunrise Landscaping. I had commercial crews, residential crews, so I turned a lawn mowing business. A guy had to actually sell a property and mortgage his house, my competitor, to buy my business from me. He couldn't believe he was doing that to a 17-year-old. He just couldn't quit talking about it while he was signing the papers. So I've always been an entrepreneur. I remember reading a book about Henry Ford when I was still in junior high, and this was all inspired by my grandfather. But this formulated my paradigms, the way I think. I'm always looking for efficiencies, how to make things more efficient. So after the Marine Corps, I bought and turned around and built and sold several businesses. Largest one was Western Office Products. I turned them around, made them profitable, sold them to Office Plus. My older sister, who's also a CPA, helped me out there. She didn't sell her stock before the Office Plus merger. I did, so because I had this other thing I wanted to invest in. So I did well, not quite as well as she did. But Margie, somewhere in a mattress, has the first dollar she ever made. I swear to God, she does somewhere. But a lot of business experience, a lot of coming into a business and telling somebody who's been running it 20 years, you're not doing it right. Let's make it more profitable. And then they get real upset with you. Well, I've been doing this 20 or 30 or 40 years. How can you come in here in 5 days and tell me how to make my business more profitable? It's because I don't have all the paradigms you have. And I'm always looking at things for efficiencies. And it's just the way my mind works. So years later, I bought my advisor's practice so he could retire. I became a financial advisor. And I immediately saw more efficient ways at investing and saving money for retirement. And then I found out the broker dealers and stuff don't want you doing that. They make less money per client if you do it that way. The client makes more money. The client pays less taxes. But the broker doesn't want you doing it. So 9 months in, I went fully independent. Now, I've been a partner at other broker-dealer firms. They brought me in to design and implement things within their business. But I've never had to answer to one. We have been fully independent since late 2004. So we answer to the SEC, we answer to the law, we answer to the state we're in, but we answer firstly to our client. There's no broker holding my license. So we work directly for the client. We get very deep into tax planning. Taxes are your number one expense. Your entire life, they're your number one expense. And people go and see their CPA and say, well, if you owe the taxes, you owe the taxes. Not if you make arrangements to not owe the taxes. I'm not talking about tax fraud. I'm not talking about questionable deductions or any of those other things. And you'll see seminars and stuff on Facebook telling you how to never pay taxes again. Well, most of those programs will land you wearing an orange jumpsuit, sharing a cell with a guy named Bubba, and those people will be long gone, by the time that happens. So you got to be careful. You got to be very careful with these things. So the advice we're giving has to be compliant. We have numerous professional licenses. We have malpractice insurance. We have fidelity bonding. We are fiduciary trustees of trust assets. So the level of accountability we have is incredibly high. One of my main, it's just an area that I gravitate to because I just have a love for entrepreneurs, is when entrepreneurs go to sell their business, they take a massive hit. And the IRS says, well, you're just paying the taxes on all the depreciation we gave you. Well, their math and your math don't quite work out the same now, does it? I got a slide here in a minute that has a joke about that. But I was helping so many business owners exit that there was a group called Sunbelt Business Brokers that brought me in to help their business brokers. And a bunch of them also became business team. So I was helping their business brokers, and I ended up owning the franchisor for Link Business. If you went to linkbusiness.com, you don't need to do it now. But I was the franchisor for the US. So I had over 30 franchisees, business brokerage firms that I was their franchisor. Plus, I owned the Los Angeles franchise. I had over 40 business brokers working for me. Plus, I maintained the financial services firm and a couple of other trustee services and stuff. And the reason we got deep into that was we would come in and clean up the business, position it. This is something Tim can really help you with. You need to be using his software to make your business more efficient and more profitable. So we use things like that so you get a higher multiple on your exit. And then I would solve the tax problem. A lot of small business owners, they go visit their CPA. He plugs in some numbers in Lacert or TurboTax or whatever software he uses, and he just tells you what you owe. And they're not trained in tax planning. They're not. And he's a good CPA. Quit bugging them. It's like going to your dentist and bugging them about cardiology. I need a second opinion on what my cardiologist told me. Well, he's a dentist. He's got small hands, hopefully. Leave him alone. What are you bugging them about cardiology for? It's not their area of expertise. It's not their discipline. Well, they'll give you an answer. If you ask them a question, they'll give you an answer. Well, it's an uninformed opinion. I mean, we spend a lot of time training the client's CPA so they can then turn around and tell the client, yeah, this is fine. And it's kind of like having your cardiologist train your dentist so the dentist can tell you, yeah, your cardiologist is okay. It's two different areas of medicine. It's two different areas of finance. And I'm not going to do your tax return, and he's not going to design your tax plan. It's two entirely different areas. They do overlap tremendously, like healthcare overlaps. So I would help these business owners at Link Business exit. Some of them literally couldn't afford to sell their business. Not enough money left over on the exit to even make it worth it. So they'll retire the day they carry them out boots first, right? From the office, but that's not a plan. I mean, you want to exit when you're young enough to take the kids camping. Tell them those scary stories that make them sleep with their flashlight all night. Okay. So you want the time to be that grandparent. You want to enjoy yourself. You don't want to work to the day you die. And so many small business owners cannot afford to exit because of the taxes. For example, in California, you lose 36% of the gain, plus you recover any accelerated depreciation.
Ugh.
Yeah, Tim. I've seen guys 46, 48% of the transaction gone.
Wow.
And I don't know why the government thinks we owe them all that money. They certainly didn't help us. They made it harder. It made it way harder for us to be successful. So everything we're going to talk to you about is how to make everything more efficient. Just keep that mindset. That's our goal, is how can we make your business more efficient so you get a higher multiple? How can we make your exit more efficient? And those of you that are listening here that want to buy other routes from other contractors, you can use us to make that transaction more efficient for both sides, the buyer and the seller. And we can make a transaction viable for both that might not have been viable. When we get done doing the transaction, when Tim gets done cleaning up with your software, making everything about your business more efficient, now you get a higher multiple, make the transaction itself more efficient. Everybody's happy. Everybody's happy. And the IRS doesn't care. The taxes just aren't owed. It's like a property that you own. Until you sell it, you don't owe the tax. Well, if the money's in a trust, the taxes aren't owed until the money comes out. And the kind of trust that we use, in case there's any CPAs and stuff here, doesn't pay any taxes on the gains inside the trust until it's withdrawn, kind of like a retirement account. So I'm going to go through this and show you how this works. We've done so many FedEx transactions, helped so many FedEx. We understand what FedEx wants. We understand what SBA wants. We can design the asset purchase agreement on both sides of the transaction. We can guide you through all that. We've done it many, many times. And because we're so deeply involved in this, we both have people that need to sell and we have people that need to buy. We can make the introductions as well. Okay. But if you went to sellmyftx.com, you can actually order a report on your business. By the way, we're probably going to send you back to Tim Goff and Norb Kohler to reorganize so those numbers look even better, but it would be good to order that report. This is a small portion of our team. I'll start first with Michael Berwick, the tax attorney. So if your CPA or attorney disagrees with something we're telling you, we have an 8-hour class that they must attend so they can become qualified to give advice on this. I'm sure they're good. I'm sure they're good people. They're just a dentist trying to give advice on cardiology. Okay. Michael Berwick taught tax law at Harvard. So the tax attorneys graduating from Harvard took his class for 4 years. He taught continuing education to the tax attorneys at the IRS. He is an expert on these topics in both trust law, tax law, and securities law. He has a master's in securities law in addition to his master's in taxation. Norb Kohler, outstanding business broker, honest to a fault. I'm telling you, honest to a fault. Lousy poker player. He is as honest as they come, okay? He understands FedEx. He understands how it works. And he'll work night and day to help you get the best exit you can possibly. And then we have Craig Redler there, the bottom left. He is an internationally respected trust attorney. He's the trustee that manages the trust we create. All right. He just came back from lecturing in Portugal to a convention. He gets paid to go to these things as a keynote speaker for international tax attorneys, international trust attorneys. There were people there from over 30 countries where he was giving the instructions. So it's not just U.S. and U.S. asset protection, but also international. All right. Then you see the rest of the team there. That's not even a third of our team. That's about 10% of our team. We have a whole series of companies that provide these services. So, for example, if you know anything about real estate and 1031, we finally just started our own accommodation service. I got tired of dealing with accommodation services that just wouldn't listen, and they would screw up transactions. So we started our own. In the process, the IRS approved our installment sale trust as an alternative to a 1031 exchange. All right, so we have a hedge fund that does capital management. We are a fiduciary registered investment advisory firm. We have a financial planning firm. I mainly run the one you see there in the middle, Q Financial. I do the financial plans. The top right there, Model Q, I wrote a white paper that Forbes published in 2004 on how to have more income in retirement, net of fees, expenses, and taxes. That was the one that forced me to leave the firm I was with because they didn't want me doing it. The client gets 50% more income, but the broker makes half as much money per client. So it wasn't approved because the broker made less money. So we went independent. And then we have a consultancy trust that manages a lot of other transactions for you. So these are just a few of the firms involved. CB Administrative Services and IST Admin Services are fiduciary trustee services. City National Bank, we use their trust platform. My Ground Force is going to help you make things more efficient. Securities, we clear through Schwab, Charles Schwab. So all those financial firms you see up there and another 40 plus firms have reviewed us top to bottom and approved everything we do, our program, our trust. We have been vetted. You can't imagine the vetting and the fidelity bonds and the malpractice insurance. You're covered. When we're giving you advice, you're covered 3 ways from Sunday. Okay. So if you run into somebody, again, we run into this, an attorney or CPA that disagrees with the advice we're giving, we have an 8-hour class that they must attend. When you go to do the calculations and you go to exit, you feel like the IRS is doing some funny math there, right? And then if you've ever been through an audit, the lower picture on the right is what it feels like, I got to tell you. Because they're really on a fishing expedition. To be honest with you, most IRS auditors aren't competent to be auditing you, to be honest with you. But we want to avoid both of these situations. We don't want you not only paying taxes on the gains, but recovering a deferral. We can continue to defer the tax. And then through a bunch of planning, we eliminate the tax a little at a time. All right. And we'll show you how we do that later. But we're not making your transaction tax free. We're deferring the tax. And then every year we knock down some of that tax in our planning methods. You come out the other end tax free. Right. So we use the installment sale trust. We also use several other methods, but we start with the installment sale trust because it is the simplest method. It's clean. It's simple. There's 2 sets of documents. One's 6 pages. One's 9 pages. It's not even complicated. We'll spend more time going over things with you than actually even filling out the forms. It's not the only method we have. It's where we start because it's simple, it's straightforward, and the IRS has approved. The goal is to maximize income. Because you need income in retirement. That's really what you need to maximize. So we want to make sure that those taxes that would have been lost stay invested. You can use those monies to go buy other investments, other businesses, or just retire and take the income. But taxes are an expense. You'll hear me say this again and again and again. Taxes are just an expense. And you can manage that expense just like you manage your electric bill by getting solar panels. Or like me, everybody teases me because I drive a Prius. I love that damn car. 48 miles to the gallon and you can't kill it. Just can't kill those cars. They're ugly. It's an ugly car.
Hang on, Kevin. Hey, how do you fit in a Prius? Are you sitting in the back seat?
No, I fit in the front. I don't fit in the back. I'm too big. I'm 6'4", 250. No, I fit in the front comfortably. Yeah, no. I tell you what, I love that damn car. It's 179,000 miles, nothing but scheduled maintenance, 48 miles to the gallon. Laugh at me if you want. I drive past all those gas stations while you're buying gas. I really don't care. So I let my wife buy the Porsche SUV to drive. She doesn't drive the miles I drive. So nice car. Her car. It's a nice car. You want to be efficient when it's necessary. So whenever we're taking long trips, we're not putting miles in that expensive car. We're running the wheels off of that little stupid Prius, right? So you need to find efficiencies in everything you do. There's a lot of money being wasted in your finances, a lot of taxes being paid entirely unnecessarily. So what we're going to do is we're going to make your business more efficient. Norb Kohler is going to help clean up the finances. Tim Goff's going to help bring a lot of efficiencies, maximizing efficiencies into your business. And next thing you know, you're selling for a much higher multiple. I'm going to make the transaction more efficient. All the way around, everybody gets more. It's as simple as you transfer the business to a trust and you hold a note that controls the trust. You can't be the trustee. That violates arm's length that's required in the tax code. There's a couple of other things you can't do. That's the services we provide. By the way, our fees are less than you pay a Wells Fargo advisor, and you get everything we're providing. You get the tax planning. You get all the accounts are managed. You get guarantees. You get a lot for that, and we charge less than they charge. It's the trust that sells it to the final buyer, and then the money comes into the trust account. You see, if you could transfer your business into your retirement account, your IRA, and have the IRA sell it to them, and the money came back to the IRA, that would function pretty much the same as we're doing. You just can't do that. The tax code is not allowed. But the trust functions just like an IRA. Your individual retirement account has to be hosted at something called a third-party administrator trustee, TPA. So if you have an IRA at Wells Fargo, they have a TPA that's managing that, or Schwab, they have a TPA that's managing it. The TPA makes sure, third-party administrator, trustees, their full name, make sure you comply with all the rules, and they do quarterly reporting to the IRS as to what happened in the account. Because the IRS doesn't trust you to tell them you took money out of the account. We're doing the same thing with the trust for the same fees Wells Fargo or Schwab is charging, right? And it has the same benefit. It's tax deferred. And then we send quarterly payouts rather than monthly. We send quarterly. By doing quarterly, that saves a lot of money. So we can charge a lower fee and you just get a larger direct deposit. We don't send checks anymore. They're all direct deposits. You get a larger direct deposit in January, another one in April. The other thing is with the trust, you have liquidity. Just like a retirement account, you can pull money out. You have to follow the rules when you do it. But that's why we're here. You call me up, you say, hey, I want to do this. How do I do it? And we can show you how to do it. Maybe you want to sell your FedEx business and buy an apartment building. We can show you how to do exactly that. Maybe you don't want to be a landlord. You want to do something else. We can show you how to do exactly that. Most people just want to maximize income and keep their taxes low. That's the main service that we provide. But if you follow that flow chart there, that's why there's no taxes due, because the money at close of escrow lands in the trust account. It's not taxable until you receive the payment. The other thing that is unique to us, the trust pays no taxes on gains. See, trust can be taxed at a very high rate. Our trust, with its operating agreement and structure, doesn't pay taxes on gains. Everything grows in the trust, tax deferred, just like an IRA account. We have a very unique operating agreement that has been approved. All right. So what happens here then is not only are you earning a rate of return on the money you put in the trust, you're getting compound interest on interest. You're also earning interest on the taxes that didn't get paid out. The money that would have been lost to the state and the feds stays in the account and keeps earning a rate of return for you, for your spouse when you're gone, or the two of you when you have Alzheimer's and don't know what day of the week it is, pays for your care. It goes to your kids, it goes to your grandkids. And while we're on that topic, a lot of parents are like, well, I don't care what the kids get. I want the grandkids. Because, you've already helped out your kids, but boy, those grandkids, they're angels. They can do no wrong. We want everything to go to them. So, but you can create something that goes on for generations. And you only need one trust, by the way. So let's say you had a FedEx business you're going to sell. Then you're going to sell the other half of the FedEx business. And you have maybe a rental home, and you want to sell that because you don't want to be a landlord anymore. You can do unlimited transactions. Our record's 43 transactions in one trust. You only need one trust, one installment sale trust. Right? Now, don't confuse this trust, by the way, with your living trust or anything else you might have. Those are separate. Those, you can't do this through that type of a trust. I was telling Tim earlier, there's over 100 different types of trust, and then there's subcategories of each of those. So people use the word trust, think that all trusts are the same thing. They're not. Different trusts function very differently. But this is the reason it works so well. The money that would have gone to the state and the feds stays invested, earning a rate of return for you. We do very well, by the way. We average about 11.1, and that's considering even the guarantees in the account, and that's net of everything. We have sub accounts averaging 15. We have one sub account that's about 38 for the year, and we have the hedge fund for part of the money. So we do incredibly well. Our Model Q strategy sailed right through 2008 and 9. Didn't lose a single client, not a single hiccup. They kept getting their quarterly income, no problem. So we can go into later how we do that. It feels like to you kind of like a self-directed IRA account, or like an annuity with liquidity, or just another bank account. So if at the close of escrow, the money lands in your account, it's taxable. If it lands in the trust account, it's tax deferred. So the money stays invested, generating a rate of return.
Hey, Kevin, we lost you there for about 30 seconds.
You did, really?
And some folks are still saying the audio's going in and out. So I just give you that feedback.
Sorry about that. How far back should I go?
Oh no, just maybe 20 seconds. And your videos hasn't restored yet, but
But you're hearing me though, right?
when you're looking straight ahead, we hear you. If you turn your head, then we don't hear you. I don't know what's going on there, but anyway, we don't want to miss a word. This is extremely
Yeah.
important info.
Sorry about that. I don't want I think two different pieces of software are trying to share the microphone.
That
So I'm
could be it.
not sure how to fix that right now. Um, what does it feel like when you use an installment sale trust? It feels like a self-directed IRA account or an annuity with liquidity, right? Or just another bank account. So if at close of escrow the money lands in your account, it's taxable. If it lands in the trust account that you've created, it's tax deferred until you take it out, like a retirement account. Very similar, feels the same. It functions under very similar rules. The IRS has no problem with anything we're doing because we're following exactly Section 453 of the tax code. We do not monetize the note. Now, sooner or later, you're going to hit Google and you're going to see some other programs out there that are in trouble with the IRS right now. We are in open communication with the IRS. I meet with them face to face at least once a year. We have good relations with them. We follow the rules. The other programs out there that offer similar benefits to this are all in trouble because they do something called monetizing the note. Can't use the note as collateral. You can't take loans directly from the account. That's monetization. There's a whole series of rules they're breaking. One of our leading competitors, their website's down now and they don't seem to be around. I think they got sued into poverty, which they should. They broke the rules. So you can get all these benefits if you're patient and thoughtful and follow the rules. You want to cut corners, well, then you're going to get in trouble. So um, I've been paid as an expert witness, an expert consultant in lawsuits against some of the other companies. The law firm suing them hired me, and I was the expert witness in those things. So I know exactly what happens in these other programs, why they get in trouble, and why they don't follow the rules. So you don't have to cheat to get in a very low tax bracket. You just have to be diligent, thoughtful, and plan ahead. You can be in a very low tax bracket. Right? We can show you how to do it. The income tax is still paid. The IRS doesn't have a problem with it. It's like your retirement account. They don't have a problem with that because eventually, when you take the income, the taxes will be paid. So it's just deferred. That's the reason for it. Right? We do an entire revenue estimator or a full pro forma report. And these two separate reports, one is pretty simple, straightforward. The next one is very detailed, goes very deep into the numbers. Your CPA will geek out on that report. Both reports are compiled by TurboTax. So they're as accurate as the data you provide. We need 14 questions answered. We can produce the report and show exactly how and why, calculate exactly your savings and additional earnings you'll receive from the accounts based on those savings. All right. So usually we have to do the pro forma report to train your CPA how this is going to work. And then later on, we train your CPA how to fill out the proper tax forms for the year that you sell. Sometimes people just use our CPA for that year and then go back to their other guy for the following years. Um, Everything really boils down to maximizing income and income planning because you want as much income without touching principal as possible. So we're still following the Model Q strategy. The strategy has become more efficient over time. I can't take total credit for the Model Q strategy. I was inspired to write that white paper from a 1970 E.F. Hutton training manual. Just a 21st century version of the famous E.F. Hutton strategy. Exactly what I'm doing. And believe it or not, it works better now than it did then because financial instruments, the financial markets, and the things we do are more efficient now than they were then. Okay. So you'll hear me use that word efficient all the time. My staff laughs when because you have to do that. That's what Tim got. That's what his business is. His business is making yours more efficient. Norb Kohler and myself, our business is making your transaction more efficient. And that's where the little profit made. And all those little numbers add up to some pretty big numbers later on. I've been involved in over 3,500 transactions. Either a CPA brought a client to me and I helped out with the transaction, another advisor brought a client to me, 30 business brokerages and 40 brokers in my Los Angeles location, 20 years. The installment sale trust been around since 1971, started at Ernst & Ernst, before they're even called Ernst & Young, for their own partners to defer the tax on the partnership and retire. In 20 years, I have 0 audits. So the next question is, well, how do you know this will pass an audit? Because the IRS writes us a letter about a transaction, our tax attorney responds with an answer to their question, and they don't even bother having an audit. They're like, thank you very much. And that's the last we hear from them. They don't even want to bother auditing once they have the information. By the way, when we do get letters from the IRS, it is 9 times out of 10 caused by the client's CPA not following our instructions. We have to go out and file an amended form with the IRS to correct the error. All right, so that's why we get so stiff about we need to train your CPA before they advise you on this. All right. You maintain full asset control of the trust assets. You can't be the trustee. You can't be the advisor on the account, things like that. That violates an arm's length provision in the tax code. But you control the trust assets, and the bank accounts. So much so that we actually have an app provided by City National Bank that you have on your phone that has a code that changes every 30 seconds. And you have to use that to log in and approve anything we do. No money goes anywhere in the account. If you go on vacation, we need you to pre-approve some certain things in the account, because we can't do certain things while you're gone, because you can't log in from outside the US. There's a restriction on that, even if you use a VPN. So the security in these accounts is incredibly high. Our fees are very low because we are independent advisors. I make the same net as if I was working as a Wells Fargo advisor. I just don't have Wells Fargo and all their staff dipping their fingers into the account for fees. You pay way less. Just don't have all the fingers in the pie. That's why we started all those other companies. You saw 6, there's actually 9. So we had to do those things so we can get the fees down and get the fingers out of the pie that aren't providing any value to the client at all. In fact, usually they're just a pain in the ass, right? So 20 years of doing this, our fees keep going down because we keep making things more efficient. I know I keep talking about that word, efficiency. Right? Now you're going to have a lot of questions, and fire away.
Kevin, that was excellent information. I have a couple questions here. Maybe you can explain how this is similar or dissimilar to a 1031 exchange. I know you have a company that does 1031s, but I think that's a question, and maybe we can clarify.
It's very similar to a 1031 exchange, and as much in a 1031 for real estate, you effectively sell your real estate to the exchange accommodator. That's where the money lands at close of escrow. Then when you identify the next asset to purchase, then the accommodator purchases the next replacement asset. So it provides you the same tax deferral as a 1031 does with real estate, but only for a business, except that you don't ever have to buy a replacement. Imagine if the money just stayed with the accommodator and they invested it at your direction and you took an income stream. Same thing. So the steps in the process are very similar to doing a 1031. In fact, the forms you fill out and stuff are very similar.
Okay. How about, I think you've answered this, but this question is here. So maybe talk us through how the trust is accessible for future investments, like investment property or another business, et cetera. How all that would work.
You come to the trustee and you have a conversation with the trustee and the advisor on the account about what investments you want as collateral for your note. Got to use the right terminology to be compliant with the tax code. So we tell you how to do that. So let's say you sold your routes for $1 million and $1 million is sitting in the trust. And you say, hey, I found this apartment building that's not far from my house. I think I could buy that at a good price right now. And with some repositioning and some remodeling, get the rents up and have a really profitable building. Well, then we can show you one of two ways. The trust can join you in the investment, or you can take a loan or a preferred equity position against the LLC that you used to buy the apartment building. And that's how you use the trust money. You can't have the trust money go directly to you, and you can't take a loan from the trust. Kind of like you can do a loan from a 401k, but you can't borrow more than 50% and you have to pay interest back. But an actual IRA, individual retirement account, you can't take loans from it. So if you take any money out, even as a loan, it's now taxable. And that's the problem the IRS has with those other programs. They do that. So you direct the advisor to invest in the next thing. And you can do that by carrying back a second on the real estate, or you can do that by the trust taking a preferred equity position in the LLC that owns the real estate. We would talk with you about the most efficient way of doing that. Oftentimes receiving the financing to buy the real estate, because you don't want to pay cash because you give up arbitrage, right? So you're going to want 25, 30% down. Well, if you fund the LLC with a preferred equity position from the trust, that becomes your down payment, and it doesn't show as debt against the property. Now you got 30% down. You can get way better terms on the financing. All right. But the trust still has 30%. So when you take your income from the property, 30% goes to the trust and 70% goes to you when you get paid out of that LLC. Well, where's the money going? Well, you're getting a tax deduction for paying yourself, your own trust. So it ends up being even more tax efficient doing it that way. We can show you the numbers and show you how that works.
Yeah, I have to admit that I thought I knew a lot. Now I realize how ignorant I was. There's probably some opportunities I had in the past. I should have leveraged some of this to my advantage more effectively. So we're still looking for some more questions. Anybody have anything else they'd like to hear from Kevin? Again, he's the guy you want to talk to when it comes to how to organize your business to prepare for an exit. This is where you want to go.
I can share a couple points with you. One of the questions we get often is, how long do you need to engage us before your exit? Oh, well, you need to engage Tim immediately. You probably need to engage Norb pretty soon, Norb Kohler, and start organizing your business. And once you find out what you can actually get for it after it being reorganized, you need to engage us at least a month on our side for the trust, at least a month before you're going to close escrow. Because we have an attorney that'll amend your asset purchase agreement. And that's how the trust is inserted in there. But the sooner you engage us, the better. And then once you see the multiple you can get, you might sell a little sooner than you would have otherwise. That way you can get your Saturday mornings back and take the grandkids out for pancakes on Saturday morning rather than standing there waiting for the tow truck to pull your truck out of the ditch because you had ice on the road that morning, right? So it's just, I hear the horror what you guys do.
Another safety score hit. So, well, this has been great. I don't have any other questions in the queue here. If you got anything else you want to share, Kevin?
Just go to sellmyfdx.com. You can engage us there. You can ask questions. You can request an appointment to go over some things.
Well, we do have a question popped up. Well, how does this strategy work for a C Corp with two co-owners? where only one will use a trust strategy?
The one that uses it, his ownership in the C Corp goes into the trust. So if you have a partner that doesn't want to do this, I've had deals where the partner didn't want to talk to us, didn't want to engage us, didn't want to talk to anybody about anything, and the other partner, it doesn't matter. It doesn't matter whether they even cooperate or not. It doesn't matter. Shockingly, I do not with just FedEx, but with real estate and businesses and stuff. I get involved often in divorces.
Oh, Lord.
Yeah. So when assets are being sold, um, one side's got to pay taxes on the distribution, and the other side gets to tax defer to the trust. And so, if you want to talk about an uncomfortable situation where two people aren't cooperating very well, have a divorce, right? So, if you have two partners, three partners, five partners in your FedEx, they don't all have to use the trust. That's a great question. I've had situations in real estate where there were five partners. Only one used this. The other four tried to 1031 and couldn't find the next property, ended up paying the tax because they didn't use our accommodation service. So if you use our, in the case of real estate, use our accommodation service, and you can't find the next property, the money falls back into the trust regardless, and the tax is still deferred. You don't fail the 1031. So we can actually sometimes use the trust to intermediate the transaction to give all sides what they want. The other thing is you can oftentimes using our strategies sell for a higher price than you could without us. Besides the taxes, we're just talking the top line price. We can show you how to have a carryback where you continue to participate in the business, and they'll pay more for the business than they would have without us because they're getting better terms on the buy side. You're getting better terms on the exit side. So we can engineer a transaction where both sides get more of what they want.
Yeah, that's very interesting. What about if um, you're selling to owners based abroad?
That's not a problem. It doesn't matter. It doesn't matter for us as long as FedEx approves it. It doesn't affect our part of the transaction.
I
In
do know
fact,
on the FedEx side, you can't have an international company that owns a TSP business, but you can certainly be an international person as long as it's a U.S. based corporation, S corp or C corp that has the contract with FedEx. It just can't be an international company that has the contract with FedEx.
our attorney, trustee Craig Redler, is an international trust attorney. So before he started doing trustee work for us, he was using us to help his international clients exit real estate. Because if you're non-U.S. Citizen, you can't use the 1031. So we would use the installment sale trust instead. So if you have some international people involved, we can show you how to do it. Show you how to do it.
So here's an interesting question. When correctly using a C corp, we can avoid up to 12 million in cap gain tax when selling. Why would we need a trust in that case to defer tax liability?
Well, you have a C corp there, so now you have more than one partner, and it's not always as simple as what you've said there. When you get done doing the math, there's still going to be some taxes owed somewhere. Right? The corporal owe it at the corporate level, pass down to the partners to avoid getting taxed twice. It's not always that simple. That sounds nice in theory, but in practice, I find in those transactions somebody still ends up owing a lot of tax. Also, if you're selling a business and you have that C corp, you probably have more than one partner. Are you guys staying partners in the C corp? What if one of them needs to exit? You can defer the tax on the exit this way as well. But if you decide to part ways, so there's still going to be something owed. There's going to be some recovery of accelerated depreciation or something. Let's do the math and find out if you're really going to get deferral on all of it like you think. Probably not.
Any other questions, folks? That was um, there's no difference of whether it's C Corp or S Corps, and well, they're obviously handled differently, but in your case, pretty much 95% of FedEx businesses are S Corps. So
Yes, yes, they are. So
there's nothing to be noted there, right?
no, no. And it doesn't matter to us if, how the asset's owned. We fill things out differently, and there's different parts to the contract between the two, depending whether it's C Corp, S Corp, LLC, sole proprietor, whatever. But it's the same transaction either way. All of you out there have heard of this. You've heard of at least one of these transactions, and it was a famous one. And if you remember when Mitt Romney was running for president, they made a big deal about he didn't pay taxes on $100 million from Bain Capital. Loopholes for the rich. By the way, there's no such thing as a loophole. If you hear your CPA use the word loophole, remind him that that's a political statement, not a factual statement. No such thing as a loophole. You're following the rules or not. The third time he uses that word, find a new CPA. So Ernst & Young set up a special purpose trust that received the partnership. This is what he did. Deferred the tax on $100 million. He pays tax on the income as it comes out of the trust, as will his wife, as will his kids, as will his grandkids for generations. But that's exactly what he did right here. And Ernst & Young set the whole program. Ernst & Young does that for all the partners of Bain, as well as other companies. So you've heard of one of these. You just didn't realize that's what it was.
Kevin, have you had any interaction with Amazon contractors selling their business?
I haven't. We've thought about touching on that market. We just haven't. The few that I've come across, it was too small of a transaction for us to do anything. They were selling for 200,000 or 150. Our minimum transaction's 500,000. Because our fees are so low. If the account's less than 500, we can't afford to have it. It cost us more to have the account than not. But no, I haven't. If anybody has some Amazon contracts, they're interested in talking with us.
Very cool. Well, we appreciate at My Ground Force. We appreciate working with you, Kevin. And we appreciate your kind words. We are universally successful in helping folks make their business worth more money. And that's what we're trying to do here.
You people worked way too hard to be giving gifts to the state and the feds. You did, and they're just going to waste the money. They really are. You remember, Tim, I spent some time as a defense contractor late 90s. And every time we saved money, they got mad at us for screwing up their budget. Every time they wasted money, they blamed the contractor like it was our fault.
Yeah.
It took 27 approvals to spend $1. There's no way the contractor can waste money. He doesn't have approval to do so. So I just remember coming away from that experience thinking, I'm not sending these bastards any dollar that I don't have to. I'm going to lock it away somewhere for at least my kids and grandkids or something. It's just at some point it's wasteful to pay some of these taxes. It really is.
Well, I really appreciate your time today, Kevin. You've been very kind to come on here and share your time. One lucky winner today is going to get a chance to talk to Kevin for free. Pretty much anybody can talk to Kevin for free, but we're going to set something up for you. And this webinar series is focused on helping you learn how to run your business more profitably. And today we talked about with an industry expert published in Forbes magazine on how to keep those profits that you earn along the way. Certainly, we appreciate Kevin emphasizing that My Ground Force can make your business worth more money. And give us a call. We can tell you how we do that. But thanks again, Kevin, for coming. Next week is going to be session number 8 in this webinar series. Next week, I'm going to talk to you about something I've been toying with. Might even write a book about it. I call it the profit chain. The world Kevin and I grew up in, we talked about kill chains. And there's a very strict process that you follow to accomplish the objective. Well, what I find when I talk to folks is maybe we don't have a defined process we follow to achieve the objective. Often we don't know what the objective is, but if profit is your objective, and it should be, then what I'm going to talk to you about is what is the kill chain? What is the profit chain for accomplishing your objective? What are those things that you need to pay attention to? There's lots of strategies out there. Harvard has published some books on the service profit strategy and all these things. But some of that stuff is so ethereal, it's not actionable. What we're going to talk about next week are some actionable methods to use to move your business towards or maximize profitability. So we'll have that conversation next week. Next week will be the last of the fall webinar series. We're going to let you guys go focus on peak, and we're going to go focus on coming up with some new releases. And then we'll be back with you likely in the spring and talk about some other things. We really appreciate your feedback. Feel free to send me an email at tim.goff@mygroundforce.com or sales@mygroundforce.com. We'd love to hear from you and see how we can potentially bring some subjects to you in the spring that you might be interested in hearing. Or if you want to hear more about Kevin, if you want to contact Kevin or hear more about what we can offer you, please reach out to us. So thanks again for attending today. Thanks again to Kevin for his outstanding presentation. I've been through it many times, and I learned some more again today. So again, we appreciate your time this afternoon, and we'll talk to you next Tuesday at 2 p.m. when we talk about the profit chain. It's Tim Goff saying thanks a lot, and you guys take care.